Good morning. Welcome to Stock Market Today for Thursday, May 7th, 2020. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. That hits your inbox every trading day before the market opens. So U.S. equities were mostly lower in Wednesday's trading, fading into the close for a second consecutive day. Utilities and energy led to the downside, while technology and discretionary were the only sectors to finish higher on the day. Treasuries were mixed, with the curve steepening due to weakness at the long end. The dollar was stronger against the euro, but weaker on the yen cross. Gold was down 1.4%, and WTI crude settled down 2.3% to break a 5-day winning streak. As we get to the desk this morning, though, a bit of a reversal, similar really to what we saw yesterday. S&P futures are up about 1.3% in Thursday morning trading. That's on the heels of Asian markets, mostly lower overnight, with China lagging. European markets are moving higher, however, here this morning. Treasuries are a little changed. The dollar is stronger against the yen and the euro. Gold is up 60 basis points. WTI crude is up 1.8%. And at 8:30 this morning, we will get the report on initial jobless claims, and estimates stand at 3 million, according to FactSet. So we roll all that up, and we look at an S&P 500 that's still in the zone that we have been highlighting. And that comes on the heels of another late day fade. So for the second day in a row, the market faded into the close of trading. Bigger picture, it kind of keeps us in the range with initial support in the 2750 to 2800 area. Below that, 2485 to 2660 also become interesting. Resistance still in that area between 2950 and 30, we'll call it 3005, although the 200-day moving average is moving lower. We're not overbought, we're not oversold, according to that 13-period CCI, as it hovers just above the zero line. Chaikin money flow is bullish, but has had a persistent downtrend since that peak in December. So when we roll all that up, still, kind of a whole lot of nothing in here. The market's made little to no progress over the past 3 weeks. And if you look at my note from yesterday, you can see that, we highlight the key levels, both to the upside and the downside. And, in between, it's kind of, it's frustration. It's chop. It's probably what would frustrate the most investors here in the near term. Is there a lot of views going on, either, for a V-shaped type recovery to the upside, or a fade and potential retest. For now, we're just watching and noticing that we really haven't gone anywhere for 3 weeks. And, that could frustrate the most people. But at the same time, it gives you an opportunity in a flat market to identify the areas that are performing the best and the areas that are performing the worst for potential ideas. So let's turn now to our market in a minute. What are we writing about in the note today? Well, we faded into the close for a second consecutive day. Breadth metrics weaken across the board this week. We'll touch on that a little later in the show. Long-term treasuries come under pressure, but bank stocks continue to lag the broader market. And it's kind of interesting because the long end of the curve coming under pressure causes steepening of the yield curve, and that's generally a positive for banks, but the banks were having no part of it yesterday. Remember, we highlighted KBE on the show yesterday, and futures point to a higher open here today. Taking a look now at the power bars across sectors, across the main averages rather, we can see that once again, the Qs were what outperformed, and that's kind of interesting because second day in a row where the market has faded into the close, second day in a row where the NASDAQ has outperformed. The Dow lost 80 basis points, 2 to 15, bulls to bears there. S&P 500 down 65 basis points, 46 to 167, bulls to bears. There's your NASDAQ outperformance, up 57 basis points. Small caps underperforming on the day, 267 to 364, bulls to bears. Bonds down, tick, sending yields higher, according to the Chaikin power bar. Large cap stocks are more bearish than small cap stocks, and the major markets across the board are mixed. Taking a look now, I've gotten a lot of positive feedback from our clients about some of the screens that I run in the notes, and so I'm kind of sticking with that theme here. Once a week, instead of a stock, just kind of looking at a screen based on some of the themes that I am seeing in the marketplace. And we highlighted the banks yesterday on the show. So what I wanted to do is kind of dig in to KBE at the holding level and look for stocks that are very bearish or bearish, right? So we take the KBE as a starting universe, whittle it down to the names that are bearish or very bearish, and there were 35. And then kind of take it further by highlighting the names that have weak money flow and weak relative strength. And that cuts that list of 35 bearish or very bearish stocks down to 11. And you can see some of the bigger picture names or higher profile names that are on this list, right? JP Morgan, Wells Fargo, and Bank of America kind of jump out at me. But it's just kind of interesting that even with the curve steepening, the banks remain under pressure. So we wanted to kind of highlight some of the names that could potentially continue to underperform the market. Taking a look at that, these 11 names kind of jumped out at me. I'm highlighting both lists, both the 35 and the 11 in my note today. So if you have that note, take a look. But I just kind of wanted to dig deeper on what was happening with the banks in light of the steepening of the yield curve on the day yesterday. So that's the genesis of this screen. Take a look at it. Could potentially warrant doing some more work if you look for opportunities on the bearish side or if you hold any of those names. Taking a look at our sector tracker now, the movement of the major sectors over the last 5 days. Only one group higher over the last 5 days, and that's tech, kind of lining up with the big picture theme that we've seen there. Comm services, which also has a lot of the fan mag names outperforming as well. Healthcare and staples towards the top of the list. Discretionary REITs, materials, and Utes are in the middle of the road, all lower. Energy, industrials, and there's your financials, the bottom of the list. So energy, maybe a little bit, we thought that the rally in energy was counter trend in nature, and it does appear to be rolling over here now again in the near term. Industrials, again, leveraged to the global economy, and then financials really just kind of interesting to me at this point, lagging badly over the past 5 days. And even with that curve steepening yesterday, the bank's coming under pressure. So I sit up and take notice when I see things like that, and we dig deeper on it in our note today. Our industry in focus, home builder services. Over the past 6 months, this group has been an underperformer, lagging the S&P 500 by 13.39%. And it has a very weak power bar ratio. Only 2 bullish stocks for 12 bearish stocks, and currently ranked number 14 of 21 subsectors, having moved down 2 slots over the past week. Now, some of the indicative names there that we want to stay away from, avoid, potentially look for downside opportunities: Armstrong World, AWI, Tempur Sealy, TPX, it's your mattress company, and Allegion PLC, ALLE, all with very bearish cheek and power gauge ratings. And as we dig in on the group itself, we can take a look at the XHB. It's the ETF that's tracking this home builders and their supply chain, right? Very bearish ETF power gauge rating and a weak trend as it trades below a declining long-term trend line. There's your 2 to 12 ratio. So what I see here is a very bearish fund that's lagging the market. Now, the intensity of underperformance has improved of late, but still a laggard. Hitting overbought conditions with mixed to bearish money flows. So to me, the ETF lines up with an area of the market that we want to continue to avoid, and we'll watch it because of that improvement in relative strength. However, just not enough there yet for me to get overly excited. I'd want to see more of the names doing better. I'd want to see kind of persistent bouts of outperformance, really since starting to lag in December, right? The attempts at outperformance have been feeble, right? Quick one here at the end of January, another quick one here mid to late February, but has not been able to be sustained. So that's something I sit up and take notice of. Taking a look at what's trending now, yesterday's S&P 500 movers and shakers are gainers and losers. Fleer up 9.6% on the heels of their earnings announcement. And then news this morning that they were awarded a contract. So that stock traded higher yesterday. Activision, ATVI, part of the stay-at-home group, up 6.3% following their earnings announcement. But I will note that their peer, Electronic Arts, did trade weakly on the day yesterday on the heels of their report. CLAC, KLAC, earnings and guidance sent that stock higher by 5.25%. DaVita reported earnings, took the stock up 4.4%, and Borg Warner BWA, their earnings report was enough to add 4.12% on the day. On the loser side of the board, Occidental, OXY, earnings report and some commentary that they may look to raise cash sent that stock lower by 12.5%. Cincinnati Financial was downgraded at Credit Suisse, doing a deep dive on what could potentially be the worst case for that bank in light of COVID-19. Investors didn't like what they read, took 9% out of the stock, close to 10% really. Leggett and Platt, no real news there yesterday. They did report earnings earlier in the week, but that stock was lower by 8.5% yesterday. Mosaic down at 8.3% on their earnings report. And SPG, didn't see anything company specific for yesterday, but do note that they were downgraded at Wells Fargo here today. So let's dig in now. On Thursdays, we look at breadth metrics. We look at metrics across time frames. And for us, we see just kind of a weakening over the past week. The percentage of stocks in the S&P 500 currently above their respective 200-day moving averages falls from about 30 last week back to 24% this week. And what's interesting to me, I started pointing this out last week, is we're not seeing the same type recovery that we saw off the low in 2018, early 2019, right? That was a true V bottom for the market, and the breadth metrics kind of pointed to that, right? They had a nice thrust higher and kept moving. It's a slower grind here with this move. What's interesting to me, though, is that what we're seeing now is more in line with what you see in past instances, or what you've seen in past instances of these breadth metrics becoming washed out. To me, 2018, early 2019 is looking more like the anomaly rather than the rule, right? And that's if we look at the percentage of stocks above their 200-day moving average. I also look at the percentage of stocks within Shaken Analytics that have bullish or very bullish ratings. Similar dynamic, not that V out like we saw in 2018, but a slower grind there. Right, we can see here the pullback percentage of stocks above their 50-day moving average. This was above 70 last week. We're back towards the low 50s now, right? So a grind out. And if we take it to an even shorter term metric, like the percentage of stocks above their 20-day moving averages, well, that really fell hard this week. It was over 90% last week, down to 40%, right? And that's all playing out as the market, had the initial thrust move higher and has really gone nowhere for the past 3 weeks. So the sideways action, while frustrating, it's an opportunity to take a look under the hood and see what's going on. And we do see some breadth in the near term beginning to weaken, or at the very least, just taking more time to get going to the upside, right? So to me, it's appearing that V up and out for breadth in 2018, early 2019 was more of the anomaly. And it looks like, from a breadth perspective, we're getting characteristics that are more in line with past instances of deeply washed out conditions here. Global markets also losing their upside traction. Taking a look at the ACWX, the iShares MSCI ACWI ex-US ETF, right? Rallied, right? Similar to the S&P 500. But what's different here is that this group is fading from the 50% retracement, while the S&P actually made it up here to the 61.8% retracement of its own move. At the same time, RSI of the ACWI having trouble getting out of bearish ranges, starting to roll over here, right? Not getting a sustained break above 60. We're watching it here as it pulls back to retest the 50 level on this pullback, but kind of stuck in a no man's land between the 50 and 200-day moving averages, while momentum has a hard time getting going. And if we look at it on a relative basis, we can see just a continuation now of underperformance relative to the S&P 500. Finally, I think the big story of the day yesterday was those long bonds coming under pressure, right? Sending yields at the long end of the curve higher, causing that curve to steepen. Take a look at TLT, the iShares 20-plus year Treasury bond ETF. Pullback on news that the Treasury may start issuing longer dated bonds. We've tested the 50-day, still holding bullish ranges. So to me, this trend is still in place until proven otherwise, but worth keeping an eye on. That's going to wrap us up for today. I will be back here with you tomorrow.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.